This is Scott Becker with the Becker Private Equity Podcast and the Becker Business Minute Podcast. Today's topic is the following. The markets rise when bad things happen. 5 quick notes. So this is a fascinating evolution that's happened in American business and American finance. Something bad happens and the markets go up, and we're going to explain some of that today. First, when a big negative event occurs to the business, market, or world, a pattern is followed. First, the markets fall in response to the crises. Second, they rise in response to expected rate softening by the Fed. The caveat, of course, is that the negative event can't be so catastrophic. It can't be nuclear war. But other than that, a bad event happens, for stocks fall, then they rise significantly as people weigh the fact that this may lead to the Fed softening rates. Second, this happens because so much of the value of the stock market and bond market is tied to interest rates. When rates go down and the money supply is looser, stocks go up and yields go down. When interest rates go up, stocks tend to go down and the value of existing bond holdings falls as yields rise. So what's happened, and this is the third point, this past week has been a pretty clear example. It's a perfect example of this. First, the markets fell last Friday on the failure of Silicon Valley Bank, the 16th largest bank in the world, in the United States, excuse me. And that was the fear that several other banks with similar problems would fail as well. So you have huge fear. This leads the markets to fall. Fourth, then the markets have a fantastic week this week as both the banks are supported and it becomes clear that there has to be longer term an easing of Fed rate hikes to avoid too much contagion and too much financial problems. Now, the fifth point in this, which is tying to the Fed, people could try and blame the Fed for this, but the Fed is doing their job well. The Fed is in a serious situation. This is the fifth point, Dave. The Fed is doing their job well, but there are notwithstanding that serious consequences to rate increases. These consequences are amplified when banks, businesses, individuals, and nations don't manage their own balance sheets well. For example, Americans as a whole have taken on $1 trillion in credit card debt. This is a real problem when the interest rate on that debt is now 20% a year. Similarly, the United States has got $31 trillion in debt or so. This is not a problem when interest rates are 1%. When they're 5%, this becomes a real issue and a real challenge. But again, the issue is these issues are amplified, notwithstanding the Fed efforts, when companies, businesses, health systems, the country, individuals take on so much more debt. Then they're much more fragile to these higher interest rates. And that's partly what happened in Silicon Valley Bank, which is much more complicated than just that. Thank you for listening to the Becker Private Equity Podcast and the Becker Business Minute.